Patrick Boyle just exposed the ugliest part of the SpaceX IPO. And it is not the rockets. It is not Mars. It is not even Elon Musk. It is your 401k. Because most people think they can avoid the SpaceX IPO by simply not buying the stock. But if SpaceX gets fast-tracked into the Nasdaq 100, your index fund may not ask for your permission. Your retirement money may become an automatic buyer. That is the real trap. SpaceX is being sold as the future of humanity. Mars colony, Starlink, Grok, a multi-trillion-dollar future, but buried inside the filing is a much uglier picture. A company valued around $1.75 trillion. A company that lost billions. A company using Starlink profits to support experimental businesses. A company with massive debt. A company buying Cybertrucks from another Elon company. A company where ordinary investors may have little voting power. And a company that may enter major indexes so fast that passive retirement money becomes part of the financing machine. This is not just a space story. This is not just a tech story. This is a retirement story. Because if you hold a Nasdaq 100 fund, a target date fund, or 401k with passive exposure, the question is no longer, do I believe in SpaceX? The question is, will the index buy it for me? And if that happens, your retirement account becomes part of the exit ramp. Insiders get liquidity, banks get paid, early shareholders get a path out, and the passive investor gets exposure to one of the most expensive space and AI stories in market history. Welcome back to Broken Economy. Today, we are breaking down Patrick Boyle's SpaceX IPO warning from the street level. Because when Wall Street says innovation, the middle class needs to ask, who is buying the risk? Let's start with the pitch. SpaceX is not being sold as a normal rocket company. It is being sold as the infrastructure layer of the future. Space, satellite, broadband, data, Mars, civilization, insurance. The filing is full of language about extending consciousness beyond Earth. That sounds inspiring, but inspiration is not cash flow. A vision is not a balance sheet. A rocket photo is not profit. And this is where Patrick Boyle's breakdown matters. The company is being presented like a world-changing empire, but the financials show a massive money furnace. Starlink appears to be the strongest part of the business, but other parts of the empire are burning cash. The AI story may be powerful for valuation, but AI losses can also become a hole that Starlink has to help fill. That is the first problem. SpaceX is not just asking investors to buy rockets. It is asking investors to buy a bundled Elon ecosystem. SpaceX, Starlink, Grok, possibly X-related infrastructure, Mars ambition, government contracts, launch dominance, and future dreams that require almost everything to go right. That is a very different risk profile. Now look at the valuation. A $1.75 trillion valuation would put SpaceX near the top of the entire public market. That is not a normal IPO. That is a national financial event. At that size, the stock is not just another ticker. It becomes an index problem. If SpaceX enters major indexes quickly, passive funds may need to buy. That means 401k money, retirement funds, target date funds, and index trackers could become buyers, not because every investor studied the filing, but because the index methodology says so. That is the passive investor trap. You do not choose the company. The index chooses it for you. And once the index includes it, the money flows automatically. That is why this story matters to ordinary people. Most people will never read the SpaceX filing. Most people will never analyze Starship launch economics. Most people will never calculate Grok losses. Most people will never inspect related party transactions. But they may still own the stock through retirement funds. That is the broken economy. Risk gets packaged. The story gets sold. The index absorbs it. The worker buys it quietly through payroll deductions. Now let's talk about the Nasdaq fast-track problem. Historically, companies often needed more seasoning before entering major indexes. But the rule changes being discussed and reported could allow mega IPOs to enter the Nasdaq 100 much faster. Supporters will say this makes the index more representative. If a company is huge, liquid, and important, why wait? That argument makes sense on the surface, but the downside is price discovery. If a company enters a major index quickly after IPO, passive buyers can create massive demand before the market has fully tested the stock. That means insiders and early holders may get liquidity at a valuation supported by forced index demand. This does not mean the company is worthless. It does not mean SpaceX cannot succeed. It means passive investors may be pulled into the trade before real public market discipline has time to work. And that is dangerous, because public markets are supposed to discover price. But index inclusion can create price-insensitive demand. The fund does not ask if the stock is cheap. The fund buys because the stock is in the index. That is not analysis. That is automatic flow. Now let's talk about the Cybertruck detail. SpaceX reportedly spent $131 million on Tesla Cybertrucks in 2025. That is not a small number, and it raises a basic governance question. When one Elon-controlled company buys products from another Elon-controlled company at major scale, investors need to ask, was this the best possible business decision for SpaceX? Was the price fair? Was the purchase necessary? Did it help Tesla's numbers? Did SpaceX shareholders get full transparency? This is the problem with related party transactions. They may be legitimate, they may have business logic, but they create conflicts. And when the same founder has influence across multiple companies, investors have to ask whether each company is being run for its own shareholders or for the broader empire. That is not anti-Elon. That is basic governance. If SpaceX shareholders are funding purchases that benefit Tesla, then SpaceX investors deserve to understand why. If SpaceX cash is used to support another company's product demand, that matters. And if this company is about to be placed into retirement portfolios, it matters even more. Now look at the debt. SpaceX is not simply entering the public market as a clean, profitable machine. It has major funding needs. It has experimental projects. It has capital-intensive infrastructure. It has launch costs. It has AI costs. It has satellite costs. It has debt. And if the IPO raises tens of billions, investors need to ask, where does the money go? Does it fund growth? Does it fund Mars? Does it fund Starship? Does it fund AI? Does it repay banks? Does it provide liquidity to insiders? Does it clean up old financing? Because those are different things. A growth IPO is one story. A liquidity event is another. A bank exit is another. A debt cleanup is another. A retirement-funded liquidity machine is another. The public deserves to know which one this really is. Now let's talk about the legal structure. SpaceX has moved into a Texas corporate environment that is more management-friendly than Delaware in some important ways. Texas corporate law changes allow companies, under certain conditions, to set higher ownership thresholds for shareholder derivative lawsuits. Reports and legal analysis have discussed thresholds up to 3%. For a company valued at $1.75 trillion, 3% would represent an almost impossible stake for ordinary investors. That means the small shareholder may have very limited power to challenge management. Again, there may be legal arguments for reducing nuisance lawsuits, but from the perspective of a retail investor, the question is simple. If something goes wrong, what can I actually do? If I have no voting power, if I cannot access key internal communications, if the lawsuit threshold is too high, if the founder controls the votes, then what am I buying? A share of ownership? Or a silent ticket to someone else's empire? That is the governance trap. The public gets exposure. The founder keeps control. The index provides demand. And the legal structure limits resistance. This is why the SpaceX IPO is not just about valuation. It is about power. Who controls the company? Who gets liquidity? Who absorbs risk? Who has voting rights? Who can sue? Who can inspect? Who can exit first? Who is locked in through passive funds? Those questions matter more than the Mars photos. Now, to be fair, SpaceX is not a joke company. It is one of the most important technology companies in the world. It changed launch economics. It built Starlink. It has real engineering achievements. It has government contracts. It has unmatched ambition. It has technical talent that most companies cannot touch. That is why this story is so dangerous. The business is real enough to make the dream believable. The dream is huge enough to make valuation discipline disappear, and the founder is famous enough to turn skepticism into a loyalty test. That is the hardest type of investment to analyze, not because there is no value, but because the value is wrapped inside myth, and myth is expensive. Now talk about Starship. A large part of the future story depends on Starship. Higher launch capacity, lower launch costs, more satellite, bigger Starlink ambitions, Mars, new payload economics, AI infrastructure in orbit. Everything gets easier if Starship works at scale. But if Starship is delayed, if reliability takes longer, if costs stay higher, if launches do not scale fast enough, then the valuation assumptions become more fragile. That is the risk. At $1.75 trillion, the market is not pricing a small delay. It is pricing a near-perfect future. And near-perfect futures are dangerous. Because in investing, a great company can still be a terrible purchase if the price assumes perfection. Now connect this to the 401k investor. The average worker is not sitting in a hedge fund office. They are working, driving, paying rent, paying insurance, buying groceries, trying to save for retirement. Their 401k may be their only real asset. And if that retirement account owns index funds, then index construction matters. If Nasdaq rules allow SpaceX into the index quickly, that worker may become a buyer without understanding the filing. They may be buying the losses, buying the debt, buying the governance risk, buying the related party transactions, buying the Mars milestone, buying the AI losses, buying the founder control, buying the legal limitations, buying all of it automatically. That is the silent harvest, not because someone forces them at gunpoint, but because the financial system routes their retirement contributions into whatever the index decides. This is why passive investing is powerful and dangerous. Passive funds are cheap, simple, efficient, useful. For many people, they are still better than stock picking. But passive investing also creates automatic buyers, and automatic buyers can be used. When a massive company enters an index, passive money flows. That flow can support valuation. That support can create liquidity. That liquidity can benefit insiders and early investors. And the worker simply sees a line item in a retirement account. That is the danger. Now what should investors watch? Watch the final IPO valuation. Watch the share structure. Watch voting control. Watch lockup rules. Watch early resale provisions. Watch whether Nasdaq includes SpaceX quickly. Watch how much passive fund demand appears. Watch what percentage of IPO proceeds goes to debt repayment. Watch related party transactions. Watch Starlink profitability. Watch Grok and AI losses. Watch Starship reliability. Watch Texas governance provisions. Watch whether ordinary shareholders have any real power. Because the headline will say historic IPO. The filing may say civilization. The media will say Mars. But the retirement investor should ask, what am I actually buying? Cash flow? A dream? A controlled company? A debt machine? An AI loss vehicle? A Starlink profit engine? A founder-controlled empire? Or a mandatory index allocation? That question matters. Now go to the comments and tell us what you think. Would you be comfortable if your 401k or Nasdaq 100 fund automatically bought SpaceX after IPO? Is this a historic opportunity, or is this a giant exit ramp for insiders and banks? Do you trust a company where Elon keeps overwhelming voting control? Do you believe the Mars colony milestone is a real business target, or a narrative tool to justify impossible valuation? And most importantly, should passive index funds be allowed to buy mega IPOs almost immediately after listing? Or should companies prove themselves in the public market first? Patrick Boyle exposed the filing. Broken economy is showing the street level consequence. Because this is not just about rockets, it is about retirement money. It is about passive flows. It is about legal power. It is about who pays when the dream is priced before the proof. Subscribe to Broken Economy for more clear breakdowns of finance, technology, markets, labor, and the real economy behind everyday life. Stay awake. Mars is the dream. Your 401k may be the fuel,